Welcome to Mark Arnold's Finance. What a week it's been with all these earnings related to big tech companies. First, we had Google and Microsoft. I'd done a video on that. Microsoft beat earnings, very sturdy company. Google had mixed results with YouTube showing some weakness. Yesterday was Meta or Facebook. They had mixed results as well. And nothing to brag about, but it beat my expectations. So I'm happy about that as a shareholder in Facebook. Be sure to watch those videos if you want to know more on those companies. But today we're going to focus on two other beasts of companies, and that's Apple and Amazon that just reported their earnings after the close. So before I get started, be sure to subscribe to my channel. I'm somebody that's very consistent with my content, so I'm not going to just disappear one day. Go back and look at my videos. I have over 100 videos now, and I post weekly, and I make sure to try to provide the best quality I can, my opinions, my strategies, and I'm transparent. I share my performance of my portfolio, even sharing the bad days, because I've had to share some videos where my portfolio hit new lows and it hasn't been pretty. So give it a shot, join me on this journey, and let's all learn together. So please subscribe. With that said, let's get started with good old Apple. Now this company, a lot of the headlines today are going to see something like this, saying Apple shares dipped after the company warns of a possible $8 billion hit from supply constraints. But they did have excellent earnings, so this is overshadowing that. And people, of course, are forward thinking, future thinking with the market, so they are looking at that next quarter and what Apple said. So if we kind of get back into the dirt of it, their earnings per share was a beat at $1.52 versus $1.43. Their revenue was a beat at $97.28 billion versus $93.89 billion. Their iPhone revenue was a beat at $50.57 billion versus $47.88 billion. Their services revenue, which I believe are the subscriptions, are $19.82 billion, which was a beat versus the expected $19.72 billion. Their other products revenue was a miss at $8.81 billion versus $9.05 billion. The Mac revenue came in at a beat at $10.44 billion versus $9.25 billion. The iPad revenue came in at $7.65 billion versus the $7.14 billion. And their gross margin was also a beat at 43.7% versus 43.1%. That was a mouthful, but overall, you'll see almost every line item except for one came in above estimates. And this is something to be very happy with if you're an investor in Apple. Now, let's talk a little bit about the shares falling. So the CFO, Luca, warned of several challenges in the current quarter, including supply constraints related to COVID-19 that could hurt sales between $4 billion and $8 billion. So I like how, of course, the news will want to get those clicks, so they go on the high end with $8 billion. But this, Apple warned that China is going to hurt them probably with all the lockdowns they're having. They get a lot of their supplies from China. And even Apple CEO Tim Cook added that the company was not immune to the supply chain challenges. So even though Apple did really well with the earnings this quarter, next quarter they're expecting a good hit to their sales. And this is something that people are going to react on more than what just got reported, because people are future looking when it comes to stocks. Now, if we kind of go back to some positive, Apple did say that its board of directors authorized $90 billion in share buybacks. And this is something that this company is very proud of. They want to be the public company that spends the most buying its own shares, and it spent $88.3 billion on buybacks in 2021. So as an investor, you want companies to buy back their shares, because if they're not, then they're diluting shares. But if they're buying them back, that means there's less shares outstanding and you own more of the company each time they buy back their own shares. So it's a great thing. It adds a lot of value to investors. Also, as a bonus, Apple did increase its dividend by 5% to 23 cents per share. Now, Apple's service business, which includes subscriptions, licensing, fees, extended warranties, grew with a very strong 17% growth. I think this is where a lot of companies, if they can be successful with their subscriptions and those kind of reoccurring revenue items, this can be a gold mine for companies. I think Apple's one of those companies that has a very strong hold with people just keeping those subscriptions, those fees, those whatever you may label them, but that recurring revenue where people just kind of pay monthly. people do that with Apple because their products are very high quality, their services are high quality. So that's a great thing. So now their smartphones grew 5% during the current quarter, yielding more evidence that their iPhone 13 is selling very well. I've known a lot of people that have upgraded this year. You see almost everyone with Apple iPhones. Everyone I know pretty much owns Apple iPhones. Very few people own Android. So with that said, Cook said that the iPhone business had a successful quarter with sales to so-called switchers, or people who previously had an Android phone but decided to buy an iPhone. I think the iPhone is so superior to any other phone. It's easy to use, it's very safe, and it might not have all the extra exciting things that some of these other new phones come out with, but Apple always seems to do things in a way where they reveal it when they feel it's done right and will be the best outcome for the customer. So I think people see that, they like that, and it's just a very sticky product. So I think that's a great thing to notice, that their smartphone business is still very strong, because that's a huge part of their business. So in summary with Apple, I think that their forecast next quarter isn't just an Apple thing, it's an all company thing. All companies in the stock market, in this economy, are suffering somewhere or another. And with Apple, we just see how sticky their products and services are, because they had great earnings in a time when a lot of companies are providing a lot of mixed results. So we see Apple remains the strongest of the strongest. So I think if you're an Apple shareholder, you should be very happy. Be cognizant of the next quarter slowing down, so on any dips, maybe add. But yeah, this is great news for Apple. Now let's move to almighty Amazon. We'll call it the Zon. So if we look at what headlines are out on it, this one says, Amazon shares fall on bleak forecast and slowest growth since .com bust. This is not a great sign if you're an Amazon shareholder right now. If we look at their earnings, they missed their earnings per share by they came in at $7.38 per share versus the expected $8.36. Their revenue was slightly a beat at $116.44 billion versus the $116.3 billion. Their Amazon Web Services, which I think is their saving grace, came in at $18.44 billion versus their expected $18.27 billion. And their advertising, which we see as being hit hard everywhere, did miss at $7.88 billion versus the $8.17 billion. So mixed results for Amazon, but the big thing here is the second quarter forecast suggests that growth could dip even further. So it's already such a slow growth since 2001, since the .com era, that it can slip between 3 to 7% growth from the year earlier. And Amazon said that it projects revenue this quarter of $116 billion to $121 billion, missing the $125.5 billion that analysts are estimating. So just a big slowdown for Amazon, I think, is what we can say with its revenue. So Amazon also owns this self-driving company called Rivian. And so, this is a company that isn't doing well right now for Amazon. It recorded a $7.6 billion loss. And, this is an electric vehicle company, and it's lost half its value, in this quarter. And that resulted in a net loss of $3.8 billion. I think this is going to take time for this self-driving company to become profitable and be very beneficial to Amazon. When it comes to self-driving, to electric vehicles being the mainstay and having that infrastructure out to be able to utilize them, it's just going to be a tough thing for a while. I think that this is something that, it's not a huge part of Amazon, but it is creating a little bit of a headache right now. So moving forward, like Google and Facebook earlier this week, Amazon is attributing much of the slowdown to the macroeconomic conditions and Russia's invasion of Ukraine. So as we saw, a lot of companies are pulling back on their advertising dollars due to the Russia invasion of Ukraine, and that's hitting Amazon with their ad revenue, right? So it's just hard because the pandemic and the war over there has brought some unusual growth challenges, and so this is what we're seeing, the outcome of it. And so Amazon, they have been navigating a host of economic challenges, including rising inflation, especially with their retail side, people aren't buying as much. And then you have the higher fuel and labor costs. So that's hitting them hard because they're all about transportation, right? Transporting their goods and trying to make it as quick as possible. So that's probably a huge expense for them right now. And then the global supply chain snarls, which we saw Apple warned about, it's going to hit Amazon as well. And then the pandemic, right? The lockdowns. There's still a lot of things being worked out with that, even though I feel we're at the tail end of it, at least here in America. So to offset some of those costs, Amazon early this month introduced a 5% surcharge for some of its US sellers. And this is the first such fee in its history, so that might be creating a little bit of volatility as well. And then last quarter, Amazon hiked the price of its US Prime membership for the first time in 4 years to $139 from $119. So about 20 bucks. And there's always going to be that group of people that just, they're going to fall out due to the increase. But I think they still have a very sticky product. So I don't think that's going to hurt them really at all in the end. So I think Amazon Prime can keep increasing to, still at some decent, healthy levels. And people are going to keep with it because there's a lot that comes with that Prime membership now, a lot of benefits. Now, Amazon Web Services, their cloud computing unit continues to do really well, and it fends off competition from Microsoft and Google. Microsoft is in second place, Google in third. And we saw that Amazon Web Services increased 36.5% from a year earlier to $18.44 billion, above the $18.27 billion projected by Wall Street. So Amazon Web Services generated 57% growth in operating income to $6.5 billion, while total operating income for Amazon fell to $3.7 billion from $8.9 billion a year ago. So all great things. And then the Rivian markdown produced the company's first net loss in a quarter since 2015. What I would say is Amazon Web Services, their cloud computing unit, part of their business, is very strong. It's in such a far first place from Microsoft and Google that I think this is its shining star. I think this is its saving grace. And just to show that they're still growing at a 36.5%, even though it has a huge lead, speaks loudly. We'll just say that. Microsoft is very healthy in growing its cloud, and it's in a sturdy second place, and then Google is in a sturdy third place. But I think of all of them, Google's probably going to fall pretty far. Eventually, I think it'll come down to Microsoft and Amazon, but Amazon, I think, will stay number one, in my opinion. So overall, I think, the slowdown with Amazon, it's something that's hitting all companies. We saw that with Facebook and Google. Apple's projecting it next quarter. I don't remember if Microsoft projected anything, but I'm sure that they did. It's just the times we're in. I believe that the pandemic propped everything up, right? Everyone had all this time at home to watch all this content. There's a lot of money that flooded into the economy and people were spending like crazy. We saw these home projects going on that I've never seen before. When I was walking around my neighborhood during the pandemic, I've never seen so many houses with work trucks in front doing remodels or upgrades or something. So now I think the legs are being kicked out and the economy's kind of coming to reality now that, hey, we had this period of a prop up and now things are coming back to reality, and we're seeing that with these big tech earnings. This kind of sets the tone for everything else. This is showing us that there's some mixed results, not so good results, some strong results. It's just showing that, the pandemic ended and now we're having to face the music, that people are having to deal with inflation, a geopolitical issue with Russia and Ukraine. Companies are dealing with, their own constraints with supply chains and employee retention and things like that. So I think we're still in for a few more quarters of a bumpy ride. I think that nothing fundamentally has changed with any of these companies, the big techs that reported this week. So I don't see any reason to jump ship with any of them. I think if you're bullish on them, you should stay bullish. And I plan on still buying my first share of Amazon hopefully soon. Maybe this pullback will help me buy a share earlier, but that's my opinion. Let me know if you guys think anything fundamentally changed with any of these big tech companies. If you think there's some big pain ahead, or if you think there's a quick rebound. I'd like to hear your opinions because I'll be buying into Amazon. I already own Microsoft. And then the other companies I have through a ETF, but it all affects us all because these big tech companies kind of guide the market. So let me know what you think, and I hope you guys have a great rest of your day. We made it through earnings this week, a big earnings week, and I look forward to providing some more content soon. Have a great day, and we'll see you on Mark Arnold's Finance.